legislation that will, we hope, if enacted, diminish the likelihood of a crisis such as this recurring. But we are constrained when we are dealing with existing mortgages and existing contracts from legislating in most cases. We don't want to abrogate existing contracts by law. We are prepared to encourage negotiation. So it's a two-track process, and I very much appreciate the cooperation we've had from the administration, particularly the bank regulators, but also Commissioner Montgomery going forward, because this committee has already responded in substantial part to the administration's request in the FHA. So we've got a collaborative effort going on, some differences, but essentially a collaborative effort on the FHA. And the bank regulators, the FDIC, the OCC, OTS, the Credit Union Administration, and the Fed have been cooperative in working with us in drafting legislation. Again, we won't have 100% agreement, but we are within, I think, a generally agreed upon framework. So that's one part of it. The other part is the ongoing effort we've had to try to persuade people to do modifications of existing contracts, although there has also been some legislative cooperation. The President has supported, and the House has in fact already passed legislation to make sure that there is no tax liability for mortgagors who are given some kind of flexibility. And one other one I would mention that I think has been a very good example and a necessary example of cooperation here. Members of this committee wrote to the Securities and Exchange Commission earlier this year and asked them to intervene with the Financial Accounting Standards Board to encourage them to make it clear to the servicers that if the servicers of mortgages in the secondary market could demonstrate that it was in the interest of the holders of the paper to do a workout, namely that it would be better for them from the economic standpoint not to foreclose, but in fact to do some reworking so there'd be a steady income stream, that they could do that. And we got the permission of the Financial Accounting Standards Board was responsive. Now, the reason I cite all these things is this: a lot of pieces have been put in place. We've got, and the bank regulators have also made it clear, to their credit, that forbearance will be allowed, that we've done a great deal to encourage the holders of the mortgages to show flexibility. We provided some tax help. We have a number of very useful organizations, neighborhood organizations, citizens groups, who are trying to work with the borrowers. What seemed to some of us some time ago, a few weeks ago, was that, well, the pieces were out there, they weren't meshing. That we had put a number of individual policies in place, but we needed to overcome the inertia of everybody in their separate sphere. A lot of efforts like that have been going on. One was this Hope Now that the administration has proposed, and we thought it would be very useful to get a report on that. And we have two panels. First, of representatives of the administration. Secondly, of some neighborhood and citizens groups, and also some of the businesses. One of the things we do want to make clear: we are not talking about legislation that compels anybody to do anything. We also, and I always want to repeat this, we are not talking about any kind of bailout in the sense of public money. No public money is going to go either to mortgagors or mortgagees. No public money is going to go to pay off people in terms of the loan. Public money is useful for helping to make sure that the advocates are available, that we can reach out. Secondly, I want to again deal with those who claim that there is some moral hazard involved here. Namely that we are going to be so effective in alleviating problems that a number of people will say, boy, that was fun, let's do it again. As anybody involved in this knows, that is not remotely true. We are mitigating pain, we hope. We are diminishing terrible consequences. Nothing we are doing, if we are 100% successful, is going to make anybody on either side of this transaction, I believe, want to go through it again. We are talking about losses to the lenders that they deserve to have because they made, in some cases, bad decisions. We are talking about pain on the borrowers that we cannot avoid, we can diminish. So I really want to make clear we are not talking about moral hazard. And there is one last point I would make, and that's the justification for all of this energy on the part of high officials of this administration, from HUD and Treasury, members of Congress. And one of the arguments is, well, why should we help these people who made bad decisions? Leave aside compassion, the fact that some people were misled. Leave aside all those reasons. There's a very good economic reason, I think in economic terms, the externalities of this crisis are severe. That is, the negative economic effects on people who, by nobody's definition, did anything remotely unwise or incorrect, are severe. In particular, we have a large number of people in this country who are making, $30,000 to $50,000, $60,000 a year. They took out mortgages. They're working hard to pay their mortgages. And they are among the victims of a widespread foreclosure pattern. Because if you own a home and you're paying your mortgage, and the house across the street is foreclosed upon, and 3 houses down and others, you get a deterioration in the neighborhood. You get vacant housing, which becomes a source of difficulty. You get a deterioration in property values. So there is an excellent public policy reason for us trying both to alleviate this crisis now and to make it less likely in the future. Are there further opening statements from my colleagues? The gentleman from Texas.